There is a question that very few people genuinely ask. Why has the American stock market not crashed yet? This is not a rhetorical question. It is a factual one. When you look at the data, when you analyze the indicators that professionals actually use, you arrive at a troubling conclusion. By every historical standard, a major collapse should have already happened, yet markets keep hitting new records. And the vast majority of investors, savers, and ordinary citizens do not understand why. What we are going to do in this video is dissect that paradox methodically, without alarmism, without sensationalism, with the numbers and the mechanisms as they actually are. Let's start with the most eloquent indicator that exists for assessing the health of a stock market. It is called the Buffett indicator. Warren Buffett, widely regarded as the greatest investor of the 20th century, once described it as the single most useful measure for determining whether a market is fairly valued. The concept is disarmingly simple. You take the total market capitalization, meaning the combined value of every publicly traded company, and you divide it by the country's GDP, gross domestic product, which measures actual economic output. The result gives you a ratio expressed as a percentage. Here is what history tells us about that ratio. Below 100%, the market is considered reasonably valued. Between 100 and 150%, economists begin to speak of caution. Beyond 150%, the term significant overvaluation enters the conversation. And when this ratio exceeds the levels seen during the great crashes of the past, it signals that something abnormal is taking place. Now let's look at where we stand today. The total United States market capitalization exceeds $66 trillion. GDP sits at around $30 trillion. That puts the ratio at over 216%. To give a concrete point of comparison, in 1999, at the peak of the dot-com bubble, just before markets collapsed by more than 60%, this ratio stood at 115%. We are today nearly double that historical record, and the market continues to rise. That single figure alone would justify a serious analysis, but it does not stand alone. If you look at the price-to-earnings ratio of the largest companies in the S&P 500, the benchmark index of American equity markets, you find an equally striking data point. This ratio, commonly called the price-to-earnings ratio, measures how much investors are paying for every dollar of profit generated by a company. A price-to-earnings ratio of 15 to 20 is historically considered normal for a mature company. High-growth technology companies can sometimes justify price-to-earnings ratios of 25 to 30. The average price-to-earnings ratio of the largest S&P 500 companies today exceeds 66. That means investors are paying $66 for every single dollar of earnings. That is more than triple the levels considered elevated during periods of normal economic expansion. The rational response to these figures would be a correction, a meaningful decline in prices to bring valuations back toward historically sustainable levels. But that correction is not happening. Warren Buffett himself, who built his fortune by buying businesses at reasonable prices, has been reducing his equity positions and now holds record levels of cash. He is waiting, but the market is not falling. Why? The answer lies in a mechanism that most mainstream financial analyses rarely address with sufficient precision: U.S. government spending and its direct effect on market valuations. Here are the raw numbers. The federal government collects approximately $5 trillion per year in tax revenues, but it consistently spends around $7 trillion, sometimes more. The gap, roughly $2 trillion each year, is financed through borrowing. The government issues treasury bonds, creates new debt, and injects those $2 trillion extra dollars into the economy every single year. That borrowed money does not disappear into a void. It circulates. It pays wages. It funds contracts. It finances social benefits that are spent on consumption. That consumption increases corporate revenues, the revenues of the same companies whose shares make up the stock indices. The federal deficit therefore acts as a permanent, artificial economic stimulus that supports corporate earnings and, by extension, corporate valuations. It is a deferral mechanism. A portion of future wealth is consumed today. It is injected into the present to maintain the appearance of growth. As long as that mechanism continues to function, markets remain supported. Why does the American government accept deficits of this scale so persistently, rather than seeking to rebalance its finances? The answer is as much geopolitical as it is economic. Since 1945, the United States has occupied a unique position in the global order. The dollar is the world's reserve currency. The majority of international trade is denominated in dollars. Commodities, oil chief among them, are priced in dollars. Central banks around the world hold dollar reserves. This position grants the United States an extraordinary privilege. It can borrow in its own currency, a currency the entire world needs to use. But that privilege is now being challenged. China is actively developing alternatives to the dollar in international trade. Several countries are seeking to reduce their dependence on the American financial system. Trade alliances are forming outside the traditional framework dominated by Washington. Faced with this shift, the United States government has chosen to maintain high levels of spending to preserve its competitive position in strategic sectors: defense, technology, semiconductors, and the energy transition. The logic is to spend now, in order not to lose ground during this period of global realignment. That choice is understandable from a strategic standpoint, but it carries direct and measurable economic consequences. When a government issues debt at scale to finance its expenditures, it increases the quantity of money in circulation. An increase in the money supply, without a proportional increase in the actual production of goods and services, mechanically leads to one thing: the devaluation of each monetary unit. That is the definition of inflation. It is precisely what we have been observing for several years with the dollar. Now, this monetary devaluation has a direct and frequently misunderstood effect on equity markets. Large institutional investors, pension funds, sovereign wealth funds, and major private fortunes all understand that the real value of the dollar is likely to continue eroding over the long term. Holding cash in that context means accepting a loss of purchasing power. The logical response is to convert those liquid assets into real assets. Companies, real estate, commodities, assets whose nominal value follows inflation rather than being consumed by it. When this logic is adopted simultaneously by thousands of funds managing trillions of dollars, it creates structural demand for equity assets that keeps prices elevated regardless of the underlying economic fundamentals of the companies involved. There is a second mechanism, even more direct. Inflation acts mechanically on corporate earnings in nominal terms. A company selling a product at $100 with a $10 margin will see its revenues and profits increase in nominal value if it can pass on price increases to its customers. If prices double, nominal earnings double, even if the company's real activity has not changed at all. Analysts observe earnings growth. Valuation models appear to justify higher prices, and investors buy. It is an accounting optical illusion fueled by inflation. Real value does not necessarily grow, but nominal figures improve, and financial markets respond to figures. This mechanism carries a significant social consequence that is consistently underrepresented in mainstream economic commentary. The wealthiest 10% of the American population owns approximately 90% of the total value of the stock market. When prices rise, driven by monetary devaluation and public spending, it is those 10% who benefit directly. Their net worth grows in nominal terms, and their relative wealth compared to the rest of the population increases. The remaining 90% live the other side of that same dynamic. Their incomes grow more slowly than inflation. Their rents increase because real estate is a real asset that investors buy to protect themselves from devaluation. The cost of daily life grows heavier. They do not hold sufficient equity portfolios to offset those losses in purchasing power. The result is a growing concentration of wealth, a gap that widens structurally between those who own assets and those who do not. Let's turn now to the question that everyone is asking. When does it stop? The system we have just described can sustain itself longer than pure economic logic would suggest. Markets can remain irrational longer than investors can remain solvent, as Keynes once observed. But there are structural limits to what a system built on growing debt and gradually devaluing currency can absorb. The potential catalysts for a major correction are identifiable. First, a loss of confidence in the U.S. government's ability to manage its debt over the long term could trigger a rise in Treasury bond yields, increasing the cost of debt service and shrinking fiscal headroom. Second, a sufficiently severe economic recession would expose the fragility of corporate earnings that have been artificially supported. Third, an acceleration of de-dollarization in international trade would reduce global demand for dollars and therefore undermine the very privilege that allows the United States to borrow in its own currency without immediate consequences. What is certain is that Warren Buffett, who has observed and navigated more market cycles than virtually any active investor alive today, has chosen not to bet on the indefinite continuation of the current trend. His strategy of holding massive cash reserves is not an admission of pessimism about the long-term American economy. It is a rigorous application of a principle he has followed for 60 years. Pay a reasonable price for what you buy. And today, at these valuation levels, he finds nothing that satisfies that criterion. That observation is itself a signal. It is not a guarantee of timing, but it is a signal. What this analysis ultimately tells us is that the American stock market as it exists today is not simply a reflection of the economic health of the companies it contains. It is the product of a combination of a commoditive monetary policy, structural public deficits, complex geopolitical dynamics, and investor behavior, driven by the need to hedge against monetary devaluation. These factors can persist, but each of them has its own limits. And when those limits are reached, the adjustment will be proportional to the imbalances that have accumulated. This is not a prediction. It is a reading of the available data